So you have learned about value investing and you know how to find out that solid value investment you're looking at out of 4 or 5 thousand companies. Or maybe you have also learned the technical analysis and figured out how to invest based upon those indicators, studies, and so on. But guess what? At the end of the day, you still need to make an outlook perspective. Are you bullish or are you bearish? Bullish means that you want to buy low so you can sell high, and bearish means that you sell at high price that you will buy at lower price and keep the difference. But what if there was an approach that allows you to trade whether market is bullish or market is bearish? What if you're not so much dependent upon the market direction to produce profit? Well, that's where the statistical investing or the market neutral trading comes into play. What's up, you all? This is your coach Manoj at optionpundit.com, the #1 site for smart traders and investors to trade safe, simple, and consistently profitable strategies, especially implementing options. When I talk about market neutral strategies, if this is your first video, I suggest that you go back to the video 1 and set your foundation from start, go step video 1, video 2, and so on, so you know exactly why and how we reached to this particular tutorial to get you started with your trading in 30 days or less. And if you have not subscribed to our channel, this is the time to hit that subscribe icon and subscribe to our channel. And if you've been enjoying, make sure that you like the channel as well and continue to send us some love. Let's talk about market neutral approach or statistical trading. Well, when you're talking about statistical trading or market neutral approach, there is a different type of investing that is available, and usually it requires you to build certain set of skills before you can implement it. What does it involve? It actually involves that you go long something and you go short something. So let's take an example. Let's say the beginning of 2022, you go long SPY, but you short NASDAQ because you think increased interest rates are going to affect the growth stocks more than it can affect the overall S&P 500. But in any case, you still wanted to minimize the impact. And that way you can create a strategy so that you are long on SPY, but you're short on QQQ, which represents the NASDAQ 100. Or maybe another way to look at that is that you go long Coke and you go short Pepsi. Maybe, or maybe otherwise, depending upon that you are going long on a strong company, but you're going short on a weaker company. It can also be implemented via looking at the strong sector and the weak sector. So you go long the strong sectors and you go short on the weak sectors. But whichever way you approach this, you will have to really get deep down and understand how the trading and how different sectors are working. So let me show you an example of creating what we call, let's say, intermarket spread. Now, if you look at my screen right now, what I have here is long SPY and short NASDAQ QQQ. So you will notice that if I would have used that approach even from the beginning of this year, I would still be making profits. And actually more than 10% profit will be there within that period of time. And the volatility is also reduced. It's not such a huge volatility because you're long one stock and you're short the another one in this case. Or maybe, for example, like let's say you may choose that you would like to go long, let's say value company, in this case maybe PG or Procter & Gamble, and maybe you want to short another company that you think will be affected because of, say, the increased interest rates. So in this case, maybe like, let's say, just for the sake of example, maybe I choose Shopify and I create that, and I can see that if I would have done that, of course, you need to figure out what will be the right ratios. But if I just look at it only simple from stock to stock perspective, you will find that this trade would have been a great trade. Now, what if we are looking at, let's say, the same sector, Coke minus Pepsi, for example. And if I look at Coke minus Pepsi, you will see that the trade would be going down, which means that probably Pepsi is actually performing better than Coke during this period, or vice versa. But the whole idea here is that you understand how many shares do you need in order to make it more neutral, but you can create a pair kind of trading as well. Now, that was a very simple example of looking at intermarket spread, creating market neutral strategies. But what if there is another way or a simpler way? And for creating simpler way, you have to understand what is options, because you will have to involve derivatives. You will have to understand how options work so you can create market neutral strategies. And let me explain to you, before we deep dive into options, let me just show it to you how and what different type of market neutral strategies actually exist that can be created using options. When you are bullish, you are making money as long as the market is going up. And if you're looking at bearish, you're making money, when the markets are actually going down. Correct? So you buy low and you sell high, or here you sell high and then you buy low. That's how typically you will look at the bullish and bearish markets, right? But what if we implement options and we create multiple strategies that can benefit from the market conditions? So let me just show you how it looks like. For example, let's say you're looking at Nifty and Nifty happens to be here at 17,700. Okay, so you may say that as long as Nifty remains between say 16,000 or 20,000, I will be actually making money in this area. I will be making money, but if it drops below this, then I will be losing money. This is one type of strategy or a range bound. Or you may say that I think Nifty by certain date will be at around this price, let's say 18,000. And then you can create this type of strategy. And this strategy allows you to still make profit, even if it's not 18,000, but maybe less than 18,000, or even more than 18,000, but beyond a certain point, then this strategy is going to result into a loss. Or maybe that if you don't believe in this, but you think, there is a range where it's going to make more money, but outside of this range, actually it will lose money. So this kind of strategy can also be created. Again, you will see it's sort of a market neutral strategy. Or in a simple way, if you were to just think about, you may say that, beyond this point, I'm okay to make money, but if it drops below this, I'm going to lose money. So this is another, not really a market neutral, but you're not projecting that the markets are going to go up in one direction confidently. You are saying that if the market even drops a little bit, I will still be able to make money, right? So this kind of approach is available, and this is just the tip of the iceberg. There are many types of things that can be created. For example, I can just start creating the strategies which are going to make money like this, or I can create strategies, for example, like let's say, I go in and like this, or I can create even more strategies which are going to profit hugely in this way, or maybe, another way like this, which is in this case happens to be similar, but I wanted to reverse it. I just drew the same structure here. So there are many ways for you to look at on how you can create the market neutral strategies. One of the very simple way of creating market neutral strategies using options is that when the markets also go up, you make money, and when the markets are going down, you still make money. So let me show you how does it look like. It looks like this. So let's say you are trading Nifty, and in this Nifty happens to be say at 17,000 here, and this is like let's say okay 17,700, that's 17,100, and this happens to be let's say 16,900. So as long as Nifty is going up, I make money. As long as Nifty is dropping below that, I make money. But if Nifty doesn't move, then in this case I will lose money. So wouldn't that kind of trading or investing approach will also be amazing? Bulls make money, bears make money, and then you can have that approach that works for you to make money from the markets. So as you can see, you can create multiple market neutral strategies using stocks or different financial instruments. But here is one thing. In order to buy stocks, you need a large pool of capital, and you also need a good set of infrastructure before you can trade intra-market spreads and other market neutral strategies or long short that I just showed to you. And that's where the power of option comes in. Options allows you to invest at a fraction of the capital which is needed for stocks, much lesser, a tiny fraction of it. You can create bullish scenarios, you can create bearish scenarios, you can create market neutral structure. In fact, you can use options for your value investing or for your technical investing as well. And I'm going to show you that in the next tutorial when we are going to show you the power of options, how options can help especially the retail traders to significantly enhance their returns and achieve their goals in a much faster way. So your homework from today's tutorial is to review all the three investment approaches: value investing, technical analysis, and this market neutral approach, and share with me which approach attracts you the most and why. And I hope you've been enjoying this journey. This is your coach Manoj. I look forward to seeing you in the next tutorial. Till then, stay safe, stay healthy. Once again, this is Manoj. Happy trading, happy investing.